Perfect.
Good.
All right. Well, welcome everybody. I am excited to be here. My name is Amy Zaslansky. I'm the founder of Book Fairies and a member of NBAA. I'd like to welcome everyone to our webinar, Financial Storytelling, Crafting Your Nonprofit's Narrative to Maximize Impact. Before we get started, if I can have everybody just change your name so that way it says your name, comma, and your organization. This way people know who you are and helps to connect and network after the fact. In addition, like any other great webinar, if you can remain on mute, and if you're doing something other than listening or while you're working and listening at the same time, if you can keep your cameras off. I will be monitoring the chat as we go through, so please put all of your questions in. This is a webinar for you, so we want to make sure that we get all your questions answered and handle any topics that come up in terms of that financial piece of it. Now, I am thrilled to welcome Laura Collins from KPMG. She is the director in the Exempt Organizations Group and has been working with exempt organizations for over 30 years. She is currently working primarily with funders such as companies and corporate foundations, but she has worked with all types of tax-exempt organizations over the course of her career. In addition, Laura is the tax advisor to KPMG's own foundation. She has served on and chaired her Regional Arts Council Grants Committee, and she also served on her local healthcare system's Institutional Advancement and Development Committee.
So
Laura has, yes, it is a mouthful. Laura has a lot of experience on both sides of the coin, both in providing that financial advice, but also on the side of being part of a nonprofit. And with that, I'm going to turn it over to Laura. But again, make sure you put any questions in your chat. In the chat, I'll be monitoring that. And we just want to make this as effective and impactful for our members as possible.
Great. Thank you, Amy. I appreciate that. It's great to be with y'all today. I am a lover of books, and I really appreciate all the hard work that you are doing in providing those and to kids, because it's so important. I do need to say just a couple of, like, one thing I'll say is I do work for KPMG. I am presenting, though, to y'all in my capacity as a volunteer. And I'm not giving tax advice. Okay. Are you hearing?
Summary.
I think somebody's.
We're going to ask everybody to mute, please, while I figure out how to mute everybody in the process.
That's okay,
Laura.
I think we're good. But anyway, I'm not giving you tax advice, but general guidance, and you will have the slide deck afterwards. I do tend to load a lot of content into a deck so that you've got reference materials after I'm gone. But what I want to do is kind of frame the discussion by the fact that I'm a CPA by training, but they're kind of an acquired taste for me. Writing is really what I like to do, and explaining things. And so we're going to talk in plain English today about finance, which it can be intimidating. And I do want to demystify some financial concepts. I'm going to talk in plain English. The one thing I'll tell you too is there's the materials are really for your use and have a lot of concepts and that may be familiar to you already. And so if it's repetitive, something you already know, that is great. If not, trying to cover a lot of waterfront here. So basically, we're going to go over some basic financial concepts, which I think you're probably all familiar with. I want to talk about stewardship, financial stewardship, why that is so important. As Amy said, I work with funders, entities that fund organizations like yours. I also have been on the grant making side, making decisions about, and this is in my own personal life, making decisions about organizations and whether they're worthy of the funds, the limited funds our organization had. And then fundraising is also an area that I've worked in as well. And so the financial stewardship piece is super important these days for funders to understand about your organization. And so we're going to talk about best practices in financial management, uh, impact evaluation, and then wrap up with talking a bit about storytelling. So the basic financial concepts, I want to lay the groundwork here that I know you understand, but just want to make sure we're all together. Basically, charitable organizations, you do have to have a system for accounting for your resources, and specifically your money. And when we talk about a balance sheet is like your net worth statement. In other words, what your own personal net worth statement, your organization's net worth at any one point in time. The income statement that you produce annually or even quarterly, that's a cumulative revenues, inputs, and out or inflows and outflows, revenues and expenses. But that's for a cumulative period of time. And so I know that's a super basic concept, but these fundamentals of revenue, the money or resources coming in, expenses, things that you have to pay for, and then the net of that, whatever your surplus or net earnings are, total assets, total liabilities, that's the balance sheet piece, as is net assets and retained earnings. So I'm going to reprise this slide. And Amy, the deck, I've revised the deck a little bit since we talked yesterday, but I'm going to reprise this slide more at the end, but because we're going to be talking about impact evaluation. But when, KPMG, we actually have a team that vets organizations for other like large funders. And these are the types of things they look at. They look at, are you running a surplus? Do you have adequate liquidity? What are your cash reserves like? Are you meeting your public support percentage as a public charity? What is your program to total expense ratio look like? Are you spending too much money on fundraising? So I'm going to go into these a little bit more. The rest are balance sheet concepts, but we'll talk more about those. But the key financial practices that you have would be to budget, to understand your program costs, uh, diversify your funding sources, make sure you have timely financial reports, understand your cash flow, understand what fundamental functional and infrastructure expenses you've got, be a good steward, create operating reserves for yourself for those times when things are difficult, be accountable and transparent, and be ready to respond to financial problems because they happen to everybody. Nobody expected COVID to happen. And then, always in everything you do, act with integrity, which I know you guys are, I'm sure, but understand there's interdependence between all of these items. So financial stewardship really creates trust, and it creates trust with your donors and funders, even your volunteers, because they know you're going to be around, your employees, if you have employees, your board members, beneficiaries, community leaders, media, and partner agencies, any kind of stakeholder that you would have in your efforts. They may at some point, they may look at your 990. They may reach out and ask for information about the financial strength of the organization. I do want to spend a moment just, again, this is basic principles, setting the groundwork on charities, what it means to be a charity. And I think that one of the key terms to me in being a charity is that you're helping others, but you're not motivated by your own interests. Another aspect of charity is that you benefit from donative and disinterested generosity. This concept is from a court case from a number of years ago, but it permeates all the regulations that we have for charities. And then to qualify, you have to meet the requirements of 501c3. 501(c)(3) is a term that gets thrown around a lot. It's kind of used generically for nonprofit, tax exempt, charitable organization, foundation. Those terms are all kind of mishmashed together, and there are definite distinctions. 501(c)(3) means you are operating exclusively for a charitable purpose. You're not benefiting private individual. You aren't spending a lot of your effort on legislation, attempting to influence legislation. And a key point here with lobbying, i.e., trying to influence legislation, is knowing the difference between when you're trying to influence legislation versus if you're helping like a regulatory agency. It could be your local school board or some organization that's administrative in nature. That's not lobbying. So what is lobbying is what we call the legislative lobbying, but regulatory that relates to those that apply the law, that is not lobbying. So that's just a little tidbit that distinction that you need to know. And we're in a political environment this year, but you're not participating in any political campaign being for or against candidates for public office. That's called the Johnson Rule. There have been efforts to try to repeal that, but I think it's a key aspect, frankly, that honestly, I think frees up charities, 501(c)(3) charities from a lot of pressure. So I'm not going to go in depth into this. This is more of a reference slide, but it gives you that comparison of like what's different between a charity and a corporation. And the biggest thing is really that you are governed by, you don't have stock, you're governed by your board, and then the other areas that I just talked about. So this is what I call my landscape slide, but I always feel like it's important to go over this with teams because like I said, the term 501(c)(3) or charitable organization or foundation, those all get kind of tax exempt. They all get kind of mashed together. So I'm setting the table here with what that universe looks like. Tax exempts are a lot of different types of entities. They include everything from trade associations to fraternities, as well as like 501(c)(3) charities. Within charities, the charitable organizations, we have three primary public charities, and then we have private foundations. Private foundations, I bring this up because I know you guys are public charities or you're associated with a public charity. So you're most likely in this donative category because you're trying to raise funds or you're receiving in-kind gifts that qualify you as a charity. But private foundations are a huge target for most public charities as far as fundraising. And they do have a number of requirements that they have to live by, different rules than you have to live by as a public charity. And I think you have to keep in mind that sometimes you'll have an interesting reaction from a private foundation when, let's say, you're having a benefit and you're trying to give them tickets, and they're like, "No, we just want to give you money, and we don't want any kind of pro bono benefit coming to our founders." And that is one of those self-dealing prohibitions that they're subject to. So bottom line, this is really just to help you understand the landscape of where you fit in all of this, and that private foundations are 501(c)(3) organizations, but they are different than the rules that you're required to play by as a public charity. They're not required to meet a public support percentage like you are, but they can be controlled by their substantial contributor. Again, a reference slide for you. So donors and funders, their expectations that I see are transparency, accountability, that you can really explain what you're doing and why you're doing it, and show them the resources you've got to accomplish your tasks. And then worthiness, that you're worthy of them investing in you. And investment is a key term in the funder world these days. And so I'm going to talk a bit more about that when we get into impact evaluation. And then the last thing in this section, or the next to last thing in this section, this is just a what you should be doing as far as uh, acknowledgement, i.e., tax substantiation for your donors. The thank you is not part of the tax code, but it's really a good thing to do. And the fact that you're timely, that you're getting that to them in time to get for their tax, or to be able to take that deduction in their tax returns. And I don't mean just individuals. This does not only apply to individuals; it applies to companies as well. So keep that in mind. I reference here IRS publication 1771, and that is a plain English IRS publication. You can Google it. It is super helpful if you have any questions about substantiation. It answers most of them. Uh, the biggest thing I think in your space is that the substantiation, it's descriptive. It describes what you received, but you do not, on that substantiation, have to value that in-kind contribution that you received. That takes a huge amount of pressure off of you as a charitable organization. You just have, and that is explicitly spelled out in IRS publication 1771. But you have to describe, we got 10,000 books from this publishing company, and brand new books. And so you want to thank them, and you want to send this to them and describe that. They may come to you with additional documentation they need you to sign, typically a form 8283, and that form will not require you to vouch for their appraisal of what those books were worth, but it will what it will do is say we received them. So that's what you're being asked to sign when you get that form from them. And then compliant, in that substantiation that you explain that there are no goods or services provided in conjunction with the contribution. There have been in the recent years, there have been some huge cases where the IRS has disallowed huge, I mean, one was over 2 million contributions where the substantiation did not state there were no goods or services provided in conjunction with the contribution. I mean, and they tried to fix it later, and then it wasn't timely. So contemporaneous is important as well. So the last thing I've got here, I think, will be of particular importance to you. When you're bringing in-kind contributions onto your books, now you got to remember your 990 is based on your books and records. It's more of a financial statement than it is, in my mind. I always tell our staff, I said, think about you're working on a financial statement rather than a tax return, because they're used to working on like corporate tax returns where there's deductions and things like that. This is really for the 990 is principally for disclosure purposes. So it's based on books and records. So you need to bring in those in-kind contributions at fair market value for the books, and which is the principal market or the most advantageous market. If it's a new book, that's pretty easy because that's your manufacturer suggested retail price, maybe even discounted a bit. But for used books or just donated books, that's a lot more complex. And I had a call with Amy and I think it was Eileen with Book Fairies yesterday, and we talked about this. And one of the things we talked about, you get huge amounts of books, and you get these boxes of books, and they're not all new books. And so maybe one way for you to think about the way you put these on your books, on your financial statements, in your financial statements, is to think in terms of where they're going. Are they going to the recycling bin? Well, then that would be a big zero. If they're used, lightly used, but they're definitely usable in your operation, then come up with some type of, we talked about the Goodwill guidelines for contributions of goods. You could use something like that, but maybe consider things in those types of tranches of pretty close to new or new, where they really could be, you could sell them, to like the used but still usable in your operation. Maybe they're going foreign to a foreign country. But think about them in those tranches, and then the ones that are just in bad shape and they're going to go to the recycling bin. That maybe that's the way you think about those. But the key thing is to have a policy, have a system, have the documentation, and make sure you're where it's really not up to. It is a requirement that the donor, if they want to take a deduction, that they receive substantiation. So it is on the onus is on the donor. But it's good if you want them to keep giving things to you to substantiate on a timely basis. So the last part of this is, again, we talked about how do you substantiate or how do you substantiate back to the donor? You're substantiating what you got, not putting your own value on it. And the key thing to know on the other side is the donor is probably going to get a in a their deduction based on cost. The cost to produce that book if it's a new book. So it's their responsibility though for establishing the value they're going to take on their tax return as a charitable deduction. So I'm going to stop for a moment. And Amy, have any questions come in via chat or?
We don't have any questions as of yet.
Okay, well, we'll keep on going then. Next, I want to talk about best practices in financial management. So I think we all have to budget. We have to budget for our homes. We have to budget for our businesses. We have to budget for our organizations. Budgeting is not necessarily a static process. And the thing I hate with my nonprofit clients that I work with, I always find out, okay, what time of year are you busy budgeting? Because it's a stressful time of year when you're trying to evaluate what you're keeping, what's staying, what's going. Cash flow management, really understanding your cash flows as far as when your big cash flows are coming in, as far as funding from grantors, and when you've got those drier periods of time that you've got to get through. I was in my prior life before I was an accountant, I was a corporate lending officer, and cash flow management was everything. And if an organization could meet its obligations, was everything that we looked at. Internal controls, making sure you've got more than one person handling those sensitive areas in your financial space, and if you're using volunteers, making sure those volunteers are qualified and you've got what we would call dual control or separation of tasks. Accounting, we talked a little bit about that, but just that you've got competent accounting people. Financial reporting, that you're sharing your financial information with your board on a regular basis. I would say quarterly is the least often. I would say that a board should expect to see your financial report. Annual is not enough. Monthly is best. And that you're complying with the regulations. One thing that came up in my discussion with Amy and Eileen yesterday is reporting your in-kind contributions on your 990. And you're supposed to report those as a non-cash revenue item, but you're also supposed to have an offsetting expense. And it helps funders to be able to see that it as one item if it's a similar type, like if it's all books or teaching materials, then that offsetting functional expense. So it's a wash in your actual 990 reporting. It comes in as a revenue, as a non-cash revenue, and then you've got an offsetting expense, which is a non-cash books, books that are, you could call it, books donated or books, in-kind expense. So it's an important area that I think, Amy, you mentioned that it's hard for funders to actually, Eileen mentioned just digging down into that. But I did take a look at that, and that is the right practice. If you have very, very limited, which this group I don't think is the case, limited non-cash contributions, I know with our own KPMG Foundation, compared to everything else it's doing, it gets, paper clips and computers for its people and things like that. It's so insubstantial that we do not report that in our revenues because it's frankly hard to keep up it. Well, we keep up with it, but it's just one of those things that it's so insubstantial. It doesn't really, it's not meriting the effort. But in your case, where you were receiving a lot of in-kind contributions of books and other materials, then that's the way to treat it. It's coming in as non-cash and going out as non-cash. Fraud prevention is especially important these days with all the cyber issues and AI coming on board.
Laura, can I
Yes,
stop you for 1 second?
sure.
We got a question from Emily, and she asked if you can explain a bit about the difference between donated goods and donated services in the
Okay.
990.
Yes. Now, donated services, you do not, there's actually a line, and I think it's part 11 of the main return, but you are not, you are required if you have an audit or even a reviewed financial statement. I didn't talk about the different kinds of financial statements that an accountant would prepare for you, but an accountant could prepare a compilation, which is just literally what you said, a review, which is there's some effort put into looking at what happened with your organization during the year, and then a full-blown audit. And an audit is going to look at, really, dig into things. If you have an audit and you're saying you're in compliance with generally accepted accounting principles, they are going to require you value donated services. On the 990, you do not include those donated services at all in your revenue statement or your expense statement. Where you put them is over in a reconciliation. I think it's part 11. That's after the balance sheet in the main 990, that it basically has a line. It says donated services. So put it there, and that way your books will reconcile with the tax return. And your net earnings, basically retained earnings, whatever you want to call it, net assets, it reconciles that from the beginning of the year to the end of the year. Hopefully that answers that question. One other thing on accounting,
What?
go ahead.
So this I think is where we're going to have the most questions that come in, because our nonprofits really do struggle with finding the best ways that we report our books coming in, our books going out, so that way it doesn't scare our funders if they're looking at the 990 and they see that we have, a $5 million budget, but half of that is, or the majority of that is donated books, or it's whether they're used books or new books.
Mm-hmm.
And again, a lot of times the books come in, we have to account for them, but they don't go out right away. And one of the things that Sarah was asking is, what is the offset to the income if the books don't go out right away? And is there an income statement impact when you give the books away?
The the and I'm a tax accountant by training, so I get in trouble when I practice like auditing, as my auditors would say. But basically, I think you book both sides of that, the revenue and the expense at the same time. So there's a net zero, and you don't have to worry about like chasing all these books as they go out. So you're booking, you got 10,000 books from the publisher as a non-cash, it's 1G on the revenue portion of the return. And then over on the expense portion of I'm thinking in terms of the return, but in your financial statements, and you would have a line item specifically for in-kind contribution or non-cash in-kind expenses. And that way it looks like a grant, even though if they're sitting in, I mean, you could get into, if you want to inventory them and put them on your balance sheet, you can, but that would be extremely complex. So if you want a simplified approach, it would be it's coming in, but assume it's going out and not having to track it, the expense piece of it as they go out, but rather just they came in and we're assuming they're all going to go out, and they go into, you've got a revenue and expense, they offset at zero.
And would that be the same if your books are being distributed across fiscal years?
Yes, just go ahead and book it. Just like if you got a 3-year grant, you're required to book all 3 years in your financial statement for accounting purposes, even though you're getting, if you're on accrual method, you're required to book the whole thing at the beginning. And even though you only got of 300,000, you got 100,000, you still haven't got the remaining 200,000. So it's the same concept, but in reverse. So I would talk with, I mean, I would talk, I was going to get back to this accounting idea in that you don't necessarily have to have CPAs. There are a lot of good accountants that chose not to. My sister-in-law is one of them who chose not to sit for the CPA exam. I mean, she sat for it a couple times. She was like, "I'm done with this," and they can work through what's best for your organization and what's representative for your organization. But for a full year, even if those books didn't go out to the next year, I would say you book it in as revenue and you book the offsetting expense at the same time. It sounds weird, but and if you have a separate line item, you can help your funders understand this is what came in. We had to book this as going out, and because it's a non-cash contribution. It's not what they're focused on. Um, Well, they may be focused on giving you books, but they also may be focused on giving you money. And so that helps them see from a cash standpoint where you stand as well. So, as I said, fraud prevention is extremely important these days. Risk management, we always talk about risk management and operational, programmatic, financial, reputational. These quadrants. Is the way we think about that. In the financial, we would include the regulatory piece. Well, actually some in the operational as well. But this is the way when we're looking at risk management with clients, is the way we think about it. And then growth planning. Let's say you're super successful. It's like, do you have enough people to do what you need to do? Do you have the resources you need to do? You need to do what you have to do. And then to wrap up this section, we talked a bit earlier about these are what I would call the golden rules. And it's like, you want to budget your resources, manage your program costs, look for diverse funding sources, and understand those infrastructure expenses that you've got. And when I say infrastructure expenses, I mean people, training, compliance, those types of things. Really understand those, because they can jump up and bite you. And there's a trend among funders where if you don't have the resources for that capacity, or the capacity to do those things, there are more funders out there that are funding what we would call capacity building than there used to be. And it used to be folks were like, no, we only want to fund a project. And more funders, I think, are really looking to partner with organizations. And I know we do this with our own foundation. We want to partner with organizations. And if we find there's a capacity area that they need assistance in, and we've got consultants out the wazoo. We do skills-based volunteering, and that's kind of what I'm doing today. It's like we provide those types of opportunities for our people to go in and help out and help figure out what it is, or do training, or even, heck, I've seen skills-based volunteering around hiring, hiring resources, and helping to vet resources for hiring. Understanding that cash flow is super important, because the reason companies go bankrupt is cash flow. I can, I can tell you that is the primary reason that they generally will go down, and it happens to organizations as well. Make sure your financial reports are timely. If the way you're going at it, they're not timely, you've got blinders on. You don't have a lot of the information that you need to operate. Exercising stewardship and responsibility, building those operating reserves over time. We've talked about and this stewardship and responsibility fits in with accountability and transparency and integrity. And then just understand this is all, everything is all kind of like linked together. And if you've got a gap one place, it's going to affect the rest of your operation. So I'm going to pause for a moment. Are there any other questions or?
Quick question on building operating reserves. What
Mhm.
do you recommend is the right amount of reserves to have before you can start investing or doing other actionable items with that money?
I can't answer that. I mean, there's no specific formula. I mean, it's it's every organization. I mean, I've worked with. I mean, I can't even tell you how many organizations I've worked with over the years, and I wouldn't be able to hazard a guess. I mean, maybe other people could, but um, I think you know when you will over time see a trend where you've got a baseline amount of funding. And I know one public charity I helped establish, about year 2 or 3, they had a sense of where their baseline was, and anything they had over that, they could start investing. So look at your within the year, your ups and downs, but also look at any that kind of constant surplus. These days, we're lucky, or not lucky, but I mean, we have inflation, but we also have higher interest rates where you could have funds invested in, higher yielding cash accounts uh, that generate 5% interest, which is pretty darn good. So you can, but that doesn't lock your money up where you can. I'm not an investment advisor, but at least you can, those funds you can get to, and it's not like they're locked up in a CD or in some type of stock. Or I think you would probably look to diversify those investments as well if you start carving funds off and investing. But every organization I work with is different. Good question though. It's a good question for you to think about for your own organization for sure. So, okay. So now let's take a few minutes to talk about impact evaluation or impact measurement. I mean, there's all sorts of terms. It's very buzzy these days. Everybody's like, buzzing about we have to measure things. And some of this is coming from ESG, from the SEC has established rules for companies to measure their environmental impact. So we're starting to see that pressure from that side. Eventually, we will see this measurement more, I think, systemic in the social side, which is where we all live. But it if you have a funder that's asking for metrics back, then get to know them, understand. First off, make sure they're actually using them, because I've seen corporate entities where they're funding and they're asking for these metrics back, and they just go, there's nobody looking at that stuff. I mean, I hate to say it, but it does happen, and because they have limited staffs as well. So, everybody thinks companies have like a gazillion people and a gazillion dollars to go into their corporate social responsibility, social impact, community investments, whatever you want to call it. They don't. They have limited dollars, limited people, limited resources, just like you'd have. So what I wanted to lay out here is there are really 4 different things that go into measurement. And one is the inputs, i.e., what was given. It could be skills-based volunteering, the volunteer hours. It could be dollars, could be in-kind contributions. The outputs, an output example would be like number of books delivered. That's a head count type of thing. Outcomes are really that initial tactical indicator. Are okay, what is happening differently because of we um, what we've put into our beneficiaries. And then the impact really is a harder thing to measure because it's typically lagging indicator. It involves longer term metrics, some cases like longitudinal type studies. So if funder is asking too much of you, I think it's okay to say, we don't have those resources. What can you do to help us out with those resources to be able to provide you the reporting that you would like to have? So it's not a matter of that you're kind of being held, uh, you know, just kind of held in hostage, so to speak, that you can't um, you can't get this money unless you give them this information. You really want to get to know them and why they're asking for the information and what they're going to use it for. Is some of it extraneous? I mean, you can question that. It's okay. So put a different way, this is just a like what I would call the results chain of the inputs create the out, basically inputs create outputs, and then the outputs are where we start to see that change, and eventually you'll see the impact from your efforts. So they want to understand your impact, but it may take time. That's another thing. You push back on a funder and say, we're just starting with you, and this is what we've done so far, but we um it takes time to have impact. Outputs, it doesn't take that much time. You can, that's a head count, and outcomes, you start to see some outcomes. But I wanted to talk a moment about investments. A lot of funders are thinking, is this organization worthy to invest in? And this is where having kind of those ratios and that information together, and I'll talk about some specific metrics in a minute, but having that, using what you're giving to other funders to share with existing funders. I know some funders, especially in the trust-based philanthropy space, are like, their first question is like, what are you producing in information for other funders? Let's look at that. Let's see if we can live with that. Let's see if that works for us. But the key thing they're trying to answer is, are your beneficiaries better off because of your programs? So, as I said here, they may actually help you develop your measurement. A funder may help you develop your measurement approach. And as I said earlier, if you you have some area and you need capacity to be built, they may be willing to help you there. And these are, I mean, on the right side of the screen, there's some retention rates. It's like, do you retain donors? Do they continue to contribute to you? Program efficiency. Basically, this is an area I think can be challenging as overhead in programs. A lot of people like to take the 990, which is your whole operation for the whole year, and take that total expense and put the program expenses over it, or the management general expenses over, over a as a numerator or a denominator of total expenses. And you've heard oh, well, that organization spends 25 cents of every dollar on admin. Well, I'm sorry, you have to have some admin. And you should push back on the concept that you shouldn't, or you should have expenses that relate to your back office and how you operate, and it's okay to have that. So the program efficiency thing, it frustrates me because it kind of penalizes people for having the overhead that they need to be compliant and run their programs efficiently. Are you improving and innovating your programs? So every organization has different key performance indicators. Figure out what you want to tell, what the story you want to tell about your organization, and develop a dashboard of those. I don't love dashboards. I didn't tell y'all at the beginning, but I'm dyslexic, so it's like dashboards kind of just make me go, like, my brain goes a little crazy. So we have tons of them at KPMG. So I always put things into simpler mode. But yeah, understand what is it that tells your story. So and again, we talked earlier, these are basic metrics that if we were doing vetting on an organization, we would calculate these things if they did not do it themselves. And so it gives us a sense of, do they have enough cash? What does that program expense ratio look like? Is most of their effort in programs? We won't penalize you not if you have some management in general. Is too much going into fundraising that's not yielding really success from a fundraising standpoint, or in your case, bringing those resources in. And then one thing I know, when I was chair of the grant committee for my arts organization, we always wanted to see if what grant we were making, what it looked like against the total revenues. It's like, is the organization too dependent on us? So I'm going to pause. That's the last slide I have in that section, and then we'll get to storytelling.
I think we're all set, Laura.
Okay. So storytelling, in my mind, is really where that quantitative information you've got comes together with that qualitative story that you have to tell. I mentioned trust-based philanthropy. It does not mean that there's any relaxation of rigor. It's more of that organizations and I see folks moving in this direction of saying, we're not going to, and I see this with the corporates where they were kind of what we would call spray and pray. They would spray a bunch of money around and then pray it made an impact. And they're not doing that so much anymore. What they're doing is they're focusing in, and I know KPMG is very focused on education. We work with First Book as one of our signature programs that we work with, but we're very focused in on the we've developed that relationship over time, and it's evolving and growing. And so we are, we trust them, they trust us, and we know a lot about them. They know a lot about us. Weaving your organization's fundamentals and KPIs into that story, that narrative, is really important. In fact, we've shifted our own foundation away from, and our foundation is actually a public charity, believe it or not. Most corporate foundations are private foundations, but weaving, really doing more on stories and then validating, validating those stories with the numbers. And so you want to look for ways to highlight your successes. I mean, you guys all know this intuitively. It's just a matter of how do you do it. And it's challenging. It's hard, but it's I don't know, it's really fulfilling to be able to explain, talk about a specific school that you provided books to or it could be a Boys and Girls Club that is, talk about the way the children's faces light up and the fact that their reading is, they're wanting to read more, and there's opportunities to take more books back to them, or, tell those stories. That's very, very important. And then make it personal and explain how you're changing lives. And because the fact with storytelling is your audience, they want to see you be successful. They want you to be, they're listening because they want to help out. So key takeaways is basically, because I want to leave a couple of minutes for questions. Financial stewardship, you achieve that through your transparency and accountability and thinking ahead. And that the tracking your financial status, getting volunteers who are accountants. They don't have to be CPAs, but volunteers that are accountants, or hiring a really good bookkeeper. They're hard to find. Or having someone in-house that wants to do that work. QuickBooks, whatever like software you're using, but somebody who understands it and really wants to contribute in that way is really important. If you don't understand something, ask for help, because the accounting community, we do want to help, and we're looking for, if you have a donor that's, I would say this for law as well, like that's a, accounting firm or a law firm that ask for help, and then be a student of your own organization. You're watching those basic financial metrics and key performance indicators. Uh, you'll see things. If you see trends that are like not good, you're in a better position to react. And like I said, find allies in the financial, and I'd say even legal community to work with you and mentor you. So that's what I have for today.
Thank you so much, Laura. I'm going to see if we can stop sharing screen because I know
Okay.
this group and they always have a
Yep.
lot of questions. And once one person asks a question, it ends up spiraling
Yeah.
into a good discussion.
Mm-hmm.
And I'm just going to remove your pin here if everyone can jump on. Larry, do you want to ask your question? We'll just ask it.
Yeah, I do have a question. Thanks for an excellent presentation.
Oh.
So when is the threshold for an audit? How big, how
Hmm.
mature does a nonprofit have to be? I get a lot of different things, and I know that is oftentimes the key to getting significant money if a corporate donor or private donor like sees an audit.
Yeah.
How
Yeah.
much should that be, and can I get it for free? A bunch of questions, but let's go with the first one for now.
Okay. Well, I'm going to say the same thing about operating results. There's not a bright line, but if you're having, in some states, if you're having to file charitable solicitation filings, um, you are required to get an audit at a certain level. So like in New York, I'm trying to think what it's the CHAR 500 form, which is the charitable solicitation form. That look at that. I don't remember, and there's two different classifications, 7A and EPTL, I think is the other one. There's two different classifications of organizations, but that might drive whether you have to have an audit. Uh, as far as whether you can get one for free, there are some firms, and in New York, you're lucky you've got a lot of nonprofit organizations, and therefore you've got a lot of firms that actually are very good. There aren't big four firms that are very good at auditing nonprofit organizations. You may not be able to get for free, but you probably can get it at a discount if you are willing to get that audit done at a time of year that their people aren't as busy as their busiest times of year. But the threshold I've seen for charitable contribution filings has generally been like in the $1 million of revenue level. There is a website, it's a National Association of State Charitable Officers.net. There's a bunch of NASCO websites, but it just Google State Charitable Officers Association and it should come up. But if you go into their resources, the state resources button, you can see literally it'll provide you a link to your state to look at what the requirements are. And if you're raising funds out of your state, like in New Jersey or Connecticut, you can look at all those states. But the attorneys general, generally their offices run those charitable solicitation areas, and they're I've attended meetings at Georgetown with them, and they realize the $1 million threshold is really low and burdensome to organizations. But it varies by state. Like Pennsylvania has a pretty low one as well. I think it used to be $250,000 of revenue, just crazy. The other thing I'd say to you is consider initially getting a compilation, which means an accountant has looked at it just to make sure things are in the right buckets and places. And then as you grow, moving to a review financial statement, which means and sorry about the dog, that there is some rigor applied to your financial statements. It's not full blown audit. And then moving to an audit. A lot of funders say they require an audit, but if you have a review financial statement by a reputable firm, it's worth seeing if they'll accept it, and explain that you're moving in that direction if you feel
Yeah, an
like you need
audit is
to.
a very big step. That's about 15K down here in the
Mm-hmm.
Philly region.
Yeah.
$15,000 is
Yeah.
it's a big part of the budget. So
Yeah. Yeah. So, and I forget, Amy's in New York. You guys are from all over. So, I'm actually sitting in North Carolina. But yeah, it's a big step. I would get to know your local firms. One way to do that, I think a really good way to get to know local accountants is if you have a finance committee, bringing non-board member like accountants onto that finance committee as potentially feeders into your board. And that way they get to know the organization. This could be a younger person who's like a senior associate or a manager at a firm. You know, they're not necessarily just a staff level, but they have some responsibility at their firm. But feeding them in that way, and with potential for them to come on the board at some point, and that will broaden your exposure to the accounting world.
We have
Thank
time
you.
for another quick question if anybody has. Okay, back to you, Larry. I know you said you had a couple.
No, that was pretty much about it. Laura answered a lot of my questions.
Yeah. Well, and I'd say the same. Again, I always kind of think of accounting and legal as similar as far as bringing folks onto your board. A finance committee is not a bad place to put a legal person either. An attorney who's not necessarily a partner in a firm yet, but they're of counsel, and that it's a good way to feed them into your ecosystem, get them to know you. One other thing, this is a bit off topic, but I'll say to you, a lot of organizations and I'm not saying you guys do this, but they don't put adequate resources in what that volunteer coordinator position is, as far as the level person. That is that volunteer coordinators, to bring people in and help you with your operation, can be invaluable and give you exposure to companies, their people, skills-based volunteering that could really augment your capabilities.
Laura, I wanted to thank you so much. And I also wanted to thank both KPMG for having you come on, and for First Book, our fiscal sponsor, for establishing this connection for us. The information is invaluable, and I know that we have a lot to think about in terms of how we write down our books in terms of when we're filing that 990. So you've definitely given us a lot of good information on there. Thank you again. And everybody, we've got a networking session in June, so hope to see everybody there.
Well, great to meet y'all, and good luck. And I hope you have great success in your work, because it's super important.
Wonderful. Thank you, everybody.
Bye.
Bye-bye.